All right, the bell's rung. Let's get right to the scoreboard for Friday, December 26th, 2025, the closing print. S&P 500 down 0.1%.
Barely a flicker.
Exactly. Nasdaq down less than 0.1%, and the Dow Jones Industrial Average off by 0.2%.
So the high-level narrative, the one you'll see on the headlines tonight, is just choppy mess.
Right, light holiday trading, no real catalysts, maybe some year-end profit-taking, just a drift.
But that's not the real story, is it? We're not interested in what the market did. We're interested in how it did it, the conviction, the internals.
And that's the core tension here. How can a flat, choppy day possibly have high conviction? That's what we need to unpack. Let's start with the volume. Was this move backed by any real money?
The volume print was, frankly, deafening. We saw consolidated volume across the NYSE and Nasdaq U close at 11.2 billion shares.
And just for context, what's the benchmark we're comparing that to?
Well, the 30-day average has been running at about 8.5 billion shares.
So that's a massive surge, over 30%.
It's a 32% surge, to be exact. And that's the first huge signal. You know, high volume on a flat day isn't noise. It means big players are making definitive moves. This wasn't a passive drift. It was active positioning.
Okay, but hold on. 11.2 billion shares on a tiny dip. How do we know that wasn't just smart money getting out? Massive distribution hiding in the holiday chop.
A fair question. And that's why we have to look at the timing. We have to look at the action into the close.
Last hour, the institutional tell.
Precisely. If it were distribution, you'd expect to see weakness into the bell. Widening bid-ask spreads, stocks rolling over. We saw the exact opposite.
An acceleration.
A notable acceleration in buying pressure. The indices pushed toward their session highs, and that push came on increasing volume. We saw spreads tightening and real strength in large-cap tech and some industrial names.
So they weren't just covering shorts. This sounds like new money being put to work.
It's the classic pattern of institutional buying the close. They're establishing long exposure, positioning for a positive start to the new year. It's a strong, bullish signal for Monday's open, at least in the short term. The high volume was confirmation of accumulation, not liquidation.
Okay, so conviction was high, institutional bias seems bullish, but an index is just an average. We have to look under the hood at the market internals. While the S&P was flat, what was the health of the individual stocks telling us?
And this is where the yellow flag starts waving. We move right to market breadth. The ratio of advancing stocks to declining ones.
And it was weak.
It was terrible. The analysis provides a global example from the BSE 500, which showed 167 advances against 332 declines.
So decliners were double the advancers, a breadth ratio of 0.5x.
Exactly. And what that tells you is that this late-day rally was incredibly fragile. It's concentrated in a few big names that the institutions were buying. It's masking broad underlying weakness.
So the generals are advancing, but the troops are retreating. That's a classic divergence.
It is. And it leads us right to the next piece of the puzzle. Volatility. Or I should say the complete lack of it. The VIX.
The fear index. The data here it's pretty astonishing.
It is. The VIX was scraping the bottom all week, hitting 13.47 at its low. The closing print for 2025 is around 18.80. That's the lowest level in over a decade.
A decade-low VIX.
Okay.
So what's the actionable takeaway there for someone trying to manage their risk?
It means complacency is absolutely rampant. There is almost zero demand for hedging. Everyone thinks volatility is dead. But, you know, these extremely suppressed VIX levels are often what precedes a sharp, violent move.
Because everyone is caught on the same side of the boat.
Right. So for you, the key is that protection options is cheap. If you see the risks we're highlighting, like this terrible breath, now is the time to think about buying that insurance.
So let's tie it all together. S&P hits a new intraday high but closes flat. At the same time, market breadth is falling apart. That is the definition of a divergence flag.
It's a classic stealth correction. A few mega caps are holding up the index, while the broader market is quietly selling off. It means you absolutely cannot buy the index blindly here. Stock selection is everything.
Which is the perfect segue. When the macro picture is this confusing, institutions hunt for clarity in individual names. They look for key reversals.
Correct. And we saw two perfect hypothetical examples on Friday that really set the stage for Monday. These are the highest probability signals you can find.
Let's start with the bullish case.
The bullish reversal was in a name, let's call it XYZ Corp. It opened way down, hit a 52-week low on what looked like bad news. But then buyers just stepped in all day. Strong, persistent buying.
And it closed positive.
Closed positive, above the prior day's close. And this is the key. It did so on double its average 30-day volume confirmation.
So smart money saw the news, decided the sell-off was overdone, and established a durable bottom right there. That's a prime swing-long candidate.
Absolutely. And then we have the mirror image, the bearish reversal in GreenTech Innovations, or GTI.
Right, this one gapped up hard at the open.
Gapped up on an analyst upgrade.
Yeah.
Pure euphoria. But sellers were waiting. They hammered it all day long, and it closed right near the session lows, erasing every single penny of that morning gain.
And again, on elevated volume.
Crucial. The institutions used that upgrade as exit liquidity. They sold their shares to retail traders who were chasing the headline. That makes GTI a high-conviction short candidate for next week.
Those are crystal clear setups. So let's synthesize this. We have a bullish institutional close, but weak internals and a decade-low VIX. How do we turn that into a strategic look ahead for Monday?
The whole setup just screams for an asymmetric trade, a trade where your potential reward is significantly greater than your risk.
Because something has to give. The market has to resolve this divergence.
Exactly. So the suggested play is a long volatility or a breakout trade, maybe using slightly out-of-money calls or puts on the SPY.
And the levels we're watching for that breakout are the gamma walls. Can you explain what those are?
Of course. Gamma walls are basically strike prices with a huge amount of options, open interest. They act like magnets for the market price.
Pulling the price towards them.
Right. A big put wall below the market acts as support because dealers who sold those puts have to buy the underlying stock to hedge as the price falls. A call wall above acts as resistance.
And a break of one of those walls can trigger a huge move.
That's the whole trade, because when a wall breaks, all that dealer hedging suddenly reverses and it accelerates the move. So you watch those gamma levels at Monday's open. A break is your signal.
That covers the index strategy. But what about those individual stocks? You mentioned institutions often wait for a day two play. Define that for us.
The day two play is all about risk management. You see a huge move on day one because of catalyst, but you don't chase it. You wait for confirmation that the move wasn't just a one-day head fake.
So let's take a bullish setup. Stock A closes up, say, 10% on huge volume after breaking a key resistance level.
Right. The day two entry isn't to buy it at the open on Monday. The entry is to buy it only if it breaks above Friday's high. That confirms the momentum is real and buyers are still in control.
And the bearish setup is just the inverse. Stock B gets crushed down 15% on bad earnings.
Exactly. The day two short entry is a breakdown below Friday's low. That tells you the sellers are still in command and there hasn't been any meaningful absorption overnight. It keeps you out of a vicious dead cat bounce.
So wrapping this up, what this framework gives you is a way to look past the headline number. We started with a flat day, a choppy mess, but what we found underneath was high conviction, major internal divergence, and really specific actionable setups.
The core insight really is that divergence. The indices are treading water, but the volume print confirms high conviction. The breadth confirms underlying weakness, and the VIX confirms dangerous complacency.
We even saw it at the sector level. Metals and mining was a leader, but industrials were a major laggard from profit-taking. It was a true stock picker's market.
So the market is coiled. It's either setting up for a massive Santa Claus rally continuation, or it's about to break under the weight of this mask distribution.
Which leaves us with a final, provocative thought for you to take into the new year. Given that the VIX just closed 2025 at its lowest level in over a decade, a historic signal of overconfidence. Ask yourself this. When implied volatility signals this much extreme complacency, how quickly will you position yourself for cheap protection if and when the unexpected finally happens?